Hi, this is Andy Filipiuk in Toronto for the week of November the 5th. Yesterday we got the U.S. election results out of the way with the Democrats taking back the House. Now the market is rallying very strongly this morning, I think on hopes of gridlock, that nothing too bad will happen. But one thing's for sure is that the Democrats will likely continue to go after Trump, and this may not be the greatest thing for financial markets. As at the time of this filming, the permanent portfolio is down 1% year to date. While it's been a very painful and frustrating year, I'm actually quite happy with these results. Starting in 2016, the U.S. Federal Reserve began raising interest rates, and they continue to do so. We are likely to see 3 or 4 more hikes over the next year. And these hikes are now starting to have a tremendous impact on financial prices. Over the last 10 years, the global economy became very, very indebted. Levels we've never seen before, worse than 2008. Now with rising interest rates, there's nothing more dangerous than inflated asset prices driven by debt with rising interest rates. And if one looks historically, central banks generally tend to keep raising rates till they break something. In fact, they cause, in all likelihood, most recessions by tightening too much and then finding out after the fact. So financial markets now, for anybody paying attention, are in a very precarious situation. We've already seen many assets roll over. In fact, 89% of U.S. assets are down this year. So it's been a very tough year, but it could get a lot worse given the fact that, as I mentioned, credit continues to tighten globally. For clients, it's essential to have a plan going into any type of market crisis or downturn. And with the permanent portfolio, I like to remind people that we're only 20% in equity. So we are not very largely exposed to the potential downside that a market downturn could create. So keep the faith. We'll keep you posted. And thank you for watching.